everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree Asset Management. We are continuing our money in motion, but this time money in motion in a new rate regime. We're talking about the highest yielding Treasury security. And this is the third installment in the money in motion series. And with rate cuts now definitively expected by the bond market for the September FOMC meeting, some perspectives in order. Specifically, even when the Fed begins their rate cutting process, the starting point for U.S. Treasury yields is far above where they stood during the Fed's last pre-COVID policy easing. That was in 2019. In other words, money's going to be in motion in a new rate regime. And for investors, that means bond portfolio decision-making will be occurring against a rate backdrop that many market participants have not experienced before. And there's one asset class that specifically stands out in this investment landscape as being the highest yielding Treasury security, and that's floating rate notes, FRNs. And without a doubt, the recent rally in the Treasury market has been rather noteworthy, with yields visibly declining from the 12-month T-bill all the way out to the 30-year bond. And these declines have been the direct result of continued disinflationary trends, but perhaps more noteworthy, concerns that the labor market may finally be weakening. And this narrative obviously has given rise to a more aggressive expectation for Fed rate cuts. Now, arguably, the Treasury market is perhaps the most well-known discounting mechanism on the planet. What do I mean by that? Well, a platform that quickly prices in changes in global investor expectations. And this is why Treasury yields are at their current readings. But, as I pointed out last week, at some point validation needs to occur. And interestingly, there's one sector of the Treasury market that is not based on speculation, and that's floating rate notes. And Treasury floating rate notes are priced based on changes in the weekly 3-month T-bill auction with a spread. So as a result, the yield for FRNs are tied more directly to the actual Fed funds trading range, as expectations for Fed policy move come into better focus, as it's presently the case. The weekly auction yield can reflect what is expected at the next FOMC meeting, not what is expected months from now. So while the 2-year Treasury yield has plunged by nearly 90 basis points since late May, the Treasury FRN yield has declined only 15 basis points over the same period. And this development has not only kept the floating rate note as the highest yielding Treasury security, but it's widened the gap versus the 2-year by anywhere of 70 to 75 basis points. So as I mentioned in my opening, rate cuts are now definitively a part of the investment landscape. But as we've seen over the last couple of weeks, expectations regarding where the Fed rate cutting cycle policy will be heading can change quickly. With disinflationary trends intact, Fed rate cut decisions, we're talking about 25, 50 basis points, you get the picture, are going to most likely be centered on jobs, jobs, jobs. And this type of investment setting will more than likely remain a key part of the overall landscape, keeping the magnitude for Fed rate cuts a fluid one. With Treasury floating rate notes already discounting a 25 basis point rate cut for the September FOMC meeting, the yield is still head and shoulders above other securities on the maturity spectrum. A perfect example is if you were to look 3 years out to the 10-year, you have 3 handles on the yields that we're talking about there, coming in at 381 to 395. So what we're talking about here for a solution, we're looking at the Wisdom Tree Floating Rate Treasury Fund, ticker USFR, to offer investors that solution to take advantage of this yield discrepancy. So that's it for this week. I hope everybody has a great rest of the week and be well.
Past performance is not indicative of future results. Securities with floating rates can be less sensitive to interest rate changes than securities with fixed interest rates, but may decline in value. Fixed income securities will normally decline in value as interest rates rise. The value of the investment within the fund may change quickly and without warning in response to issuer counterparty defaults and changes in the credit ratings of the fund's portfolio investments.